Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. And I think that everybody's mind is on one particular person. And this particular person is Ben Bernanke. And of course, what came out of the Fed last week, looking at it from the standpoint of them being somewhat disappointed in the economy, not moving forward as much as what they thought. But as we've talked about in previous webcasts, that there must be large concerns out there. And so as we think about it, a lot of us are starting to get critical of what the Fed is doing. What is the end game in here, and how will this play out? So could it be, for instance, that actually Ben Bernanke might be looking at things with rose-colored glasses? That does he really understand what's happening on Main Street in America? Or is it of such a high finance situation that a lot of these things are being ignored in here? So the way that we want to think about it is to really think about it in terms of your average customer in here. And when we look at your average customer, is that just think about what this customer is experiencing right now. As we said, persistently high unemployment, persistently high unemployment. And we got that again this past week with jobless claims still remaining up above the 400,000 level. Of course, there's energy costs that everyone's dealing with, and that this is at least a little bit of a bright spot, that we've seen those prices come down as anticipation around the world in terms of bringing in those oil reserves along with the thoughts of a slowing U.S. economy. So that has come down, but they still remain high. Food and food prices still remaining high. Yet, on these two concerns, the Fed sits there and says, well, you really have to look at inflation without these two elements. But this is affecting your average customer. Then we look at housing, and we know that this is the real weak point in the United States. So when we look at the weak housing situation, is that this adds to your overall customer's concern about what's going on. I also throw in the whole aspect of taxes, and the taxes, the concern over the question mark of taxes and where will we go, especially with raising the national debt ceiling. So with these things in mind, what I'd like to do is to talk about camels, because I think that your risk committee or your board, ALCO, should really be concentrating on what kind of risks are happening out there. When we hear from bankers in terms of overall credit risk, is that this seems to be a growing situation out there. What we're seeing is that in terms on loans are being loosened by competitors. It's almost going back into a replay into 2003 again when interest rates were low. So what we're seeing are banks willing to take very low rates, starting to ease up on credit standards, and looking at it from the standpoint of overall maturities on the loans just being extended further and further out in order for these banks to get the volumes that they need. So what we're seeing out there is a growing credit risk. That on top of the fact that we really, as we talked about last week, we've really not seen non-current loans heading down. Then if we look at from the standpoint of interest rate risk, and the whole name of the game with interest rate risk is from the standpoint of the yield curve. And we've talked about this week after week because the yield curve just keeps on changing in here. So when we look at that curve, amazingly enough, on the 3-month bill, we got down to 0.01. If we look at the 6-month, 0.08, 1 year in here today is still bouncing that 0.15. But let's think about the 2-year area of the curve. And when we think about the 2-year area, at the end of May, we were at about a 0.5. We got down as low last week as a 0.33, moving up in here today to about a 0.35. Could we think that the 10-year could even get lower? Well, on Friday, we hit a 2.87. Currently in here today, more like a 2.90, but still lower than we were last week. So this pressure remains on the yield curve. What do we do from an interest rate risk standpoint? Once again, I think you have to be more liability focused in here than asset focused. When we think about asset yields, and we were talking about loans and how low those yield on loans are, think about mortgage-backed securities in here. Amazingly enough, we're looking at mortgage backs. The 10-year mortgage back being about a 2.08. And looking, of course, at premiums that are very high on these particular type of mortgage backs. 15-year moving up to a 2.77. Then looking at even 20-year paper, do we even break a 3% in here? Yes, we go all the way up to a 3.25%. When we think of that in terms of those kind of yield levels at historical lows in here, lower than even in 2003, the question is, this duration risk, is it worth taking for these kind of yields? And yet we can think about still, in my mind, looking at municipal bonds in here and looking at tax-exempt municipal bonds and realizing the tax-exempts, the concern over credit ratings out there, that one of the things that we've used in terms of helping our clients with the tax-exempt sector are our S&B municipal ratings. So even on an issue that you might be considering buying, as part of your pre-purchase diligence, you can go in and get a Seafried & Brew independent rating on a municipal bond. Along with that, your post-purchase, you can track the credit trends in your entire municipal portfolio to understand what's going on. But with that in mind, tax-exempt yields in here, for a 10-year tax-exempt, a 4.09. When you look at 15 years, you're looking at a 5.22. And think about this in relationship to when people want from you 10-year and 15-year term loans in here, including mortgages, and comparing it to those mortgage-backed yields we looked at in here in relativity. Because I would still argue you can get a lot more geographical diversity built into the overall bank, reducing risk by looking at the tax-exempt, the bank-qualified tax-exempt market in here. I think it still looks very cheap. I think it has room to actually decrease in yields, which we've been seeing over the past month, that yields have been edging down. And I think that that is going to continue in here. The other piece, when we look at a serious strategy in here, which would actually improve the whole aspect of capital risk and where we think capital risk is going, and the needs to basically put together a capital plan that is a dynamic capital plan that works with your strategic plan, is that the strategy in here to deleverage the balance sheet in a profitable way is something that I think every bank should consider in order to reduce capital risk and at the same time be able to put on lower and lower costing deposits. So if we mix that into an overall strategy, one can be in a position to increase capital and perhaps also increase profitability. So when we look at the mix of these different things, looking at camels, is that every board should be reviewing all of their different risk factors, really understanding it from a number of different aspects in terms of not only risk, but also strategy. So when we come back to thinking in terms of how we move forward strategically, how does our risk profile change within that? One of the ways, of course, that you can do that is to basically monitor your Seafried and Brew total risk index, which then underneath has all of the different components of camels. So you can look at overall risk, you can look at different risks in terms of your capital, your credit risk, your liquidity risk, and your earnings at risk. So using an independent source such as the Seafried and Brew Total Risk Index can help to create that overall risk-reward strategy. Have a good week. This is Jay Brew, co-chairman of Seafried and Brew.